Three principles of successful investors. Are you one of those investors for whom things just seem to always work out well? Getting superior long-term returns seems to take a little effort. Whatever strategy you use seems to eventually work. You don't spend much time or effort, yet most of the time you're feeling quite confident about your investments. Or you're the type of investor who always seems to struggle. It seems everything you buy goes down right after you buy it. When you sell it, it takes off. The investments you hold long-term, tend to underperform. So we've often encountered both types of investors. Struggling investors are far more common. They usually have trouble believing that many investors outperform with little effort. Those that find investing effortless just shake their heads at the frantic activity of struggling investors. This applies to both professional and amateur investors. So why is it that investing is so easy for some and for others it's always a struggle? So we found that the biggest reason for this difference is an underlying belief system of successful investors. This belief system tends to result in effective behavior. The success of the investor tends to result more from the behavior than from the specific investments they own. So from our years of experience, we can usually get a good idea of how successful an investor is just from talking with them and identifying their belief system, even if we know nothing about their investments. So there are three main principles that tend to make up the belief system of successful investors. The first one is, let's call it faith. So the single most important characteristic of successful investors is faith. So this includes faith in the markets, in the future, in the free enterprise system, in the ability of good companies to grow their profits, and in humanity. So successful investors tend to have this confidence and optimism. They see how much humanity has progressed in recent history and tend to see that their optimism is realism. They don't know how things will turn out all right. They just know that they will turn out all right. This faith tends to give them a long-term focus. They don't need to keep searching for great investments or do all kinds of transactions or get into the latest fads because they're confident that their investments and the markets will perform well over time. Whenever their investments are down, the same confidence allows them to just see it as an opportunity to buy more. They tend to get good advice or choose their investments carefully, but then hold them for a long time. So how can they outperform so easily? All you need to do to outperform is to own high quality investments for long term and generally buy more whenever they're down. That's all. So the markets produce a good rate of return over time based on history, and so should your investments if they are high quality. At least twice each decade, there's usually a significant down market, which is the opportunity to invest more at lower prices. This alone means your return will be higher than the investment itself if you buy more when it's low. This is usually done with high-quality mutual funds, broad index funds, or a well-chosen diversified portfolio of stocks. We do it with a portfolio manager that finds all-star managers that have all beaten their indexes over the long term and that we believe are among the world's smartest investors available to us. Whichever specific investments they have, successful investors tend to have a calm confidence in their investments. The reason this is so important is that one of the single most important factors in investing is to stay invested and keep investing at market lows. So many investors will make decent returns during a bull market, but then make the number one mistake in investing by selling their after the market tanks and losing years of growth. By selling, they miss the inevitable recovery. So this number one investing mistake is a direct result of not having faith. So confident investors know that market declines happen, but since the markets have historically risen about 75% of years, declines are never probable. They are never focused on avoiding the next 20% downtick, but rather on being invested during the next 100% uptick. So it's that viewpoint. Meanwhile, struggling investors tend to have anxiety about investing, a fear of losing money, and a general pessimism resulting from lack of faith. They are constantly searching for the right investment, the right time to buy and sell, and use charts to try to market time effectively. They tend to believe that recent trends will continue and tend to follow their gut. Most of their information is free information from the news, internet, or other investors. They're always concerned about, the apocalypse du jour, like the next crash or deflation or inflation or a bad government or whatever it is. Anxious about missing opportunities, scared of losing money, and usually have a grossly exaggerated view of how risky the markets actually are. So they're often, performance maniacs, which is what we call them. So their lack of faith leads many of them to behaviors that tend to reduce investment returns, such as frequent trading, market timing, performance tracing, trend following, lack of diversification, and most significantly, getting caught up in a bubble or selling after a crash. The key point is that because successful investors have faith in the markets and their investments long term, they focus on participating effectively in the long-term market growth. Struggling investors with all their activities end up trying to outguess random stock movements. So the number 2 quality is patience. So the most successful investor, Warren Buffett, often says the stock market is a highly efficient mechanism for the transfer of wealth from the impatient to the patient. Successful investors tend to focus on having high quality investments and or advice and tend to stick with them long term. Struggling investors tend to change their strategy, investments, advice, often based on their outlook. For this reason, we consider them to have what we call STD, which is selection and timing disease. The delusion that anxiously searching for the best investment, sector, strategy, and timing it right is the key to successful investing. So studies such as the Dalbar study from 1994 to 2020 showed that the average investor makes only about 55% of the return of the investments that they own, just a bit over half. And this becomes, with compounding, this becomes 75% less after 30 years of compounding. In other words, 75% of lifetime returns are lost by performance chasing, speculative euphoria at peaks, panic capitulation at market bottoms, market timing, buying investments because of recent returns, and other similar investing mistakes. These mistakes result from the short-termism, the short-term viewpoint, and cost on average 600 basis points per year. Or 500 basis points per year. That's 5% a year of your return. So struggling investors, or as we call them, investors with STD, often focus on the cost of investments, fees and taxes, but don't see the huge cost of their investment disease. A great example of the problem with short-termism was the markets early in 2009. Did that look like a screaming buying opportunity to you at the time? It was right after a 40% market decline in 6 months. For patient investors, this was as obvious as King Kong smashing buildings in New York. It was definitely one of the most obvious buying opportunities of the last 70 years, and likely the most obvious one during our lifetime. We published an article on the $1 Million Journey blog in March 2009, which is on my blog as well, about irrational pessimism, pointing out the obvious buying opportunity. That was in March 2009. It was, for us to think long term, it was just totally obvious. Yet many people that somehow think they are able to time markets, obviously they can't, missed the early 2009 screaming buying opportunity by simply having faith, being patient, and investing more whenever the market declines. You could not possibly have missed such an obvious buying opportunity. And actually that month, March 2009, at the bottom of the market, was the single biggest net sales in the stock market. Like people were dumping their stocks at the bottom. That's the people with STD, selection and timing disease. So this was the largest market decline in the last 70 years, which is why it was the best buying opportunity of the last 70 years, period. If you just have faith and patience that the markets go up long term, you would have no hesitation in buying more when it is low. In contrast, investors with STD focus on short-term, random market movements, news, chart formations, and market timing. They're trying to predict where the market would move next, which is never obvious. So they probably missed the best buying opportunity of our lifetime. When you compare any two investment strategies, you will usually find that nearly always the one that results in fewer transactions is the superior strategy. Often the study will point to some other reason, but you just look at how many transactions they do. We've been surprised at how often we have noticed this effect over the years. Fewer transactions are more effective. This is why, for example, studies show that women are significantly better investors than men. If studies are ever done, we believe they will show that investors in broad market indexes generally do well, but investors in narrowly focused ETFs will do poorly over time. The ETFs themselves will do fine, but because they are made for market timing and have an average hold of only 12 days, the investors in narrow ETFs will generally do poor in our opinion. A rather humorous example of this phenomenon happens in families where one person, it's usually the guy, handles all the investments for both spouses. The portfolio of the spouse, usually the wife, tends to have a higher return than the investing spouse's return. This happens because he tends to trade more actively with his own portfolio. This tendency applies to investment advisors as well. Most of the advisors that I've talked to, that's what they actually will admit to it, where their spouse's account usually has a higher return than their own. Just like amateur golf, successful investing is more about avoiding mistakes than about making that great shot. As one advisor put it, my wife and I have almost always had the same investments, except that I've done more stupid things in my account. The key point is that successful investors are patient with their investments, choose them well, and have a long-term view. Number 3, discipline. So discipline is the decision to keep doing the right things. It is the decision not to do something wrong. So struggling, STD investors with selection and timing disease tend to ask what's working now, while successful investors care about what's always worked over time. So discipline is part of why it is so important to have a long-term financial plan and why we don't take on clients without a financial plan. Successful investors are goal-oriented and therefore planning-driven. Struggling STD investors are market-oriented and therefore performance-driven. When you know your number, so that's the nest egg you will need to have the retirement you want, you tend to be focused on long-term financial freedom. This makes you far less likely to be thrown off course by a bear market or market bubble or the myriad of financial events that happen in the world or in your life. Fundamentally changing the portfolio when your goals have not changed is virtually always wrong and will depress returns. If struggling STD investors have an advisor, they tend to think their advisor's main job is advice on the selection and timing of investments. Successful investors, however, usually realize that the number one job of their investor is not investment A versus investment B, but proper financial planning and to modify the natural tendency of the investor to behave inappropriately. Behavioral financial books list many irrational behaviors that result from the logical shortcomings of the human mind. Successful investing requires the discipline to prevent those mistakes. In short, the behavior and the belief system of the investor are the key factors in superior lifetime investment returns. Struggling investors are usually afflicted with selection and timing disease, STD, while successful investors tend to have faith, patience, and discipline. So thanks for listening. That's my talk this week. My name is Ed Rempel. My blog is Unconventional Wisdom. It's just edrempel.com. It's the #1 blog in Canada for a full-service financial planner. I also have a YouTube, which is edrempel.com/watch, a podcast, edrempel.com/listen. Thanks for listening, and we'll talk to you next week.